10 years after the high point of the financial crisis, its effects on the real estate industry continue to be felt. High property prices, low interest rates, high investment pressure, and low returns on investments. But the industry is doing well. It has evolved and has become more international and more digital. Sensitivity to the uncertainties of the global market remains omnipresent, however. Also at EXPO REAL 2018, the biggest real estate industry get-together in Europe.
Geopolitical risk has had impacts around the world. So if we look at markets like France, which had a presidential uncertainty 12 to 18 months ago, France now seems to be coming out of that, so we're seeing a little bit more activity in the French market. German market had a little bit of political issues earlier this year. That seems to have been overcome now by investors who are coming quite fast back into the German market. So political uncertainty does have an impact on the real estate markets, but it seems to be quite short-lived.
I
think that the geopolitical vibrations are currently being overrated and have little to do with who is in the White House or whether Brexit will happen or not. The big issues are the climate, a sometimes alarming concentration of wealth in just a few hands, and the refugee problem, with 64 million refugees who, right now, somewhere in the world, are looking around for a home.
The greatest risk in the real estate market today would have to be the rapid rise of interest rates. However, on a relative basis, our interest rates, even if they take a significant step forward, are at historical lows.
Despite the geopolitical situation, the industry continues to look to the future with optimism and is relying on a variety of investment locations. What we're seeing right now is capital flowing from Asia into European markets. At the moment, it's still very focused on hotspots. In addition, we certainly see opportunities in the B and C locations as well, if they have good forecasts where demographics and economic development are concerned. The B and C locations are clearly less affected by geopolitical turmoil than the A locations because a far more defensive product is involved. In other words, rents are much lower here. Even if the economy went through a difficult period, these tenants would continue to be able to pay their rent. The fact that there's hardly any speculative new construction in these B and C locations also plays a role.